Hello and welcome to this short presentation on how an effective cash management proposition can help you to enhance your conflict of interest policy. Let's just start by bringing everybody onto the same page about what the definition of a conflict of interest is, and it's quite simply it's where the interest of one party conflicts or is not aligned with the interests of another. And there's a couple of examples here. Common examples using doctors or politicians, where a politician acts on behalf of an organisation that's paying them to get a new rule or regulation or piece of legislation through. But similarly, within the financial services business, when in the past financial advisors have sold products that pay higher rates of commission, and currently financial advisors could actually be accused of selling a product because it's the only way to get paid. So all these are examples of potential conflicts of interest. So whether we actually like this or agree with this is not really the issue. The fact remains many conflicts of interest occur within the industry, and financial advisors have to deal with these on a daily basis. And a lot of these conflicts are incurred when advisors blindly follow sales requirements or requirements of the firms or of a product provider in favour of actually doing what's best for the client. Unfortunately, whilst a client may be engaged in a conflict of interest, it may not reflect on them immediately, but it could certainly return to haunt them at a later date when they least expect it to do so. And there's a few examples of what these conflicts of interest might have been in the past: Arch Crew, Equitable Life, Scarps, so on and so forth. So the FCA brought in the requirement for a conflict of interest policy so that anybody who deliberately abuses any conflict of interest can get pulled up short and identified very quickly. It's a worse situation when an advisor acts in the most appropriate way, only to fall foul at a later date, which is brought around by a situation that's not directly related to the initial sale. And a lot of times these things occur when a stock market collapses, a client loses money, and the financial advisor can find themselves in a position where good advice has now turned into bad advice. Other situations could be when funds collapse, or even in a past business review, which has happened with a number of networks where financial advisors have been following established policies, but then when the FCA's instigated a past business review, they've been found to have not provided as much as was possibly required by the regulator and the client. So first of all, consider this example. You are the beneficiary of a trust. Your solicitor keeps the money in their client account earning 0.25% interest per annum, and the solicitor holds this money here for 10 years. You find out you could have been earning 2.5% per annum from cash, which is equivalent to 10 times more than you have been doing, and this has cost you £22,500 over the term of the trust. 3 questions at this point. Do you make a complaint? Is the solicitor liable? And could or should they have done more? Okay, so depending what your thoughts were on the previous slide, now consider this one. You're a client. You have £100,000 on deposit. Your deposit account is not very good, so you decide to invest £80,000 with the help of a financial advisor to get a better return on your money. After 5 years, the £85,000 has fallen to £65,000 due to poor stock market performance. You find out you could have earned £9,700 in interest if you'd left your money in cash. Same 3 questions. Do you make a complaint? Is the financial advisor liable? And could or should the financial advisor have done more? Okay, so again, depending upon your thoughts and feelings on the answers to the previous questions, to resolve this issue, imagine if the remaining £20,000 that was held on deposit was actually put into the best producing interest rate accounts, and at this moment in time delivering £388 per annum. Which isn't a lot of money, but in setting up these deposits, the client would also have to have been informed that they could be earning £1,940 from the full £100,000. And the point here is that whilst this is a good return, it's not brilliant. So we now have a situation where the client's disappointed with the £1,940, so they go ahead and they make the £80,000 investment, and the £20,000 underpinning that is managed in the most effective way. If that £80,000 now falls in value, the client is no longer in a strong position to complain, because the value of the cash was made perfectly clear. The client fully understood the best possible return they could obtain from the £100,000, and then they've chosen to make the investment from that position of understanding, realizing that there is a fluctuation in value that may or may not occur, and that the value and performance of an equity-based investment is not guaranteed. Okay, so now we can actually see that we're in a much stronger position and a much better position. So getting back to the three questions, could the client complain? Well, yes, they could, because there's never anything to stop a client from complaining. But the reality here is that they wouldn't actually get very far, because is the financial advisor now liable? Well, no. The financial advisor has clearly demonstrated the value of the benefit of cash, which was the original asset class, and the client has chosen to undertake the more risky option of investment based upon the information that they understood from their cash management. And even so, from that point, the remaining cash held on deposit has been managed in the most effective way. So could or should the advisor have done more? Well, clearly no. All available options were discussed, all available solutions have been undertaken, and all asset classes have been managed most effectively. The bottom line is the advisor is not responsible for the performance of the stock market, but they are responsible for the level of information that they provide to enable the client to make their best decisions. And in this example now, we can clearly see that the advisor has done all that they needed to do. So if you really want to start to mitigate some of these conflicts of interest and some of these issues which ultimately come around to bite you in the back at a later date, then you need to make sure that your centralized investment proposition includes the effective management of cash, which is used to underpin every single investment portfolio that your business undertakes. And in doing so, you'll be clearly demonstrating the value of all asset classes to your client, and you'll be making sure that your client gets the balance of their portfolios right, but also fully understands the value of all asset classes, and therefore can't use the benefit of one against you at a later date because it wasn't fully considered. Just to close the circle completely, you also need to make sure that your remuneration policy allows you to facilitate a charge for advice and any recommendations relating to cash, and this will then demonstrate that you are not bound to sell a regulated product to get paid, which again will go a long way to sustaining the value of your conflict of interest policy. Okay, to summarise what we've covered in the previous slides, let's have a look here at how an effective cash management proposition helps you to overcome your conflicts of interest. And starting with remuneration, if you can demonstrate that you are earning money and generating revenue from the provision of holistic advice for the management of cash, then you can demonstrate that you are no longer required to sell a regulated product to generate income, and therefore you are mitigating that conflict of interest. You are also providing clients with clear information, which clearly demonstrates the value of cash deposits alongside equity-based investments, and the client is therefore in a fully informed position on all relevant asset classes, which enables you to justify the advice better and mitigate any form of conflict of interest. Suitability of advice. So if the client fully understands the beneficial value of cash and the opportunity value of equity-based assets, they're in a better position, and you're in a better position to demonstrate and understand that the advice is suitable. But the most important measure here is not demonstrating that the advice is suitable today. It's when the stock markets turn sour and the client's maybe not happy with their investment return, that the real requirement to demonstrate the suitability of cash applies. And when you've underpinned it with an effective cash management proposition and demonstrated to your clients that you've been helping them to manage and understand that asset class as well, you're in a much better position to demonstrate suitability of advice. And finally, with appropriate product performance, cash is the only asset where you can clearly demonstrate and explain the performance to be expected. And when it's underpinning an effective equity-based portfolio, this allows you to and the client to better understand the reason for making the investment, and allows them to ride out any kind of fall in value. So I hope you've enjoyed the presentation, and you can see now clearly how an effective cash management proposition can help you to sustain and develop your conflict of interest policy. If you'd like any more information or to find out more in any way, shape or form, please contact us on one of the methods shown on this slide, and we look forward to hearing from you.